And good evening, everybody. I want to say welcome to my presentation today, which is being entitled, You Are Your Own Guru. And much of what I'm going to say is actually going to echo over many of the things I believe you already heard from several of the presenters over the last couple of days. My presentation and the whole subject matter that I'm going to be talking about is truly based on understanding the law of nature. And to do that, I have, in my own career, gone and studied the Elliott wave principle. And two of my teachers and my mentors for the Elliott wave principle were Robert Prechter and Dan Ascani, both of whom I learned the Elliott wave from back in the late 80s. And so I have been using it and following it for over 40 years and continues to prove to be very accurate and not that difficult to use. So I want to talk about that today and how we all can be our own gurus. And what I kind of mean by that is that being able to not look outside for all of the entries, exits, and indicators and things that we use to provide us with the information for where do we enter, where do we exit a trade, how do we do it, and et cetera, et cetera. But I believe that if you can learn, so it's through education, that you then can make your own decisions and you can base it on solid, proven methodologies. So let me get started. So what we're seeing right now is the S&P 500 cash index. And this index actually goes all the way back, starts in 1928. So right now we have about 93 years of data. And it's quite a long trend. So, but let me get started here with what I want to talk about today. And basically, when I was first sitting down and doing analysis, I came up with this idea that when I was an options market maker, and that was the basis of my career, I started here on the Pacific Exchange in San Francisco, and I was an options market maker. And I also traded on the London traded options market, the European options market, the DTB in Germany, which is where I got my first experience with totally electronic markets. And then I came back here to the United States and continued to trade on the Pacific Exchange until I retired and moved to my home office. But what I was really looking at the time is that I came up with that in the eye of a storm, it's at the center of a hurricane. And that is where there is calm. And why? Because in a hurricane, there's the front wall and there's the back wall. And in between is the center of the hurricane, the eye of the storm. So in the midst of all of the many socioeconomic storms currently moving around the globe, making decisions is often swayed by crowd behavior or pain as prices race in both directions. So opportunities present themselves during chaotic, panic-driven times. And these opportunities are often missed due to all the noise that could be going around you. So one of the things in my early days of my career that I found is I would watch some of the other market makers who in this pit of yelling and screaming and hands going up and whipping around and being bumped and pushed were people that absolutely could pick trades. I go, yep, buy them, yep, sell them, and just put these trades together. And I always was like so amazed at how they could possibly stand in all this chaos and do that. But then I realized that that was what I needed to do. I needed to be able to focus and therefore find the eye of the storm in the center. And often that's within us. So in the center where there is calm, then I'm going to hear and I'm going to see and I'm going to react appropriately. But in the beginning, this is how I describe trading on the various options exchanges that I have had the privilege of being a member of. But to arrive at that panic state of crowd behavior would have involved total human behavioral participation. So what I'm saying is that all of the human senses become involved. So sight, smell, touch, hearing, and taste. Now today, I describe trading as totally electronic and totally anonymous, where the size of a crowd producing the behavior has exponentially grown from a few hundred in the pits to hundreds of millions that are trading around the globe 24/7, producing trillions of transactions. So all of the human senses continue to become involved. The difference is that the triggers are flashing green and red numbers across several screens. So the touch is your finger on the mouse, with the hearing being the occasional loud bursts that come out of your mouth towards the flashing red and green numbers. And the taste is the bile rising as the red and green flashes intensify. And all the rows are now in unison, flashing red or flashing green. And finally, the smell is also coming from within and will forever be associated with the smell of fear, as another circuit breaker is triggered and the trading is being delayed again. Now, one way that I found that I could quiet myself, that I could really just get myself into the mindset where I could see through and not hear all of this chaos going around me, was to learn how I could walk in and already have an idea of what I can expect and where I need to position myself and how I need to do it. So that's why I turned to the Elliott Wave Principle. The Elliott Wave Principle, along with Fibonacci number sequences, is a truly magnificent analytical tool that has stood the test of time. So I just want to start by giving a little bit of background as it was written by R.N. Elliott. So he starts by saying that no truth meets more general acceptance than that the universe is ruled by law. Without law, it is self-evident there would be chaos. And where chaos is, nothing is. So navigation, chemistry, aeronautics, architecture, radio transmission, surgery, music, the gamut. Indeed, all of art and science, all work in dealing with things animate and things inanimate under the law because nature works in this way. Since the very character of law is order or constancy, it follows that all that happens will repeat and can be predicted if we know the law. So even though we may not understand the cause underlying a particular phenomenon, we can, by observation, predict that phenomenon's recurrence. The sun was expected to recurrently rise at a fixed time thousands of years before the cause operating to produce this result was known. Indians fixed their month by each new moon, but even today cannot tell why regular intervals characterize this heavenly sign. Spring plantings were witnessed the world over because summer is expected as the next in order. Yet how many planters understand why they are afforded this constancy of the seasons? In each instance, the rhythm of the particular phenomenon was mastered. So we as human beings are no less a natural object than the sun or the moon and its actions too. So our actions are also a natural object. So in their metrical occurrence, they're all subject to analysis. Human activities, while amazing in character, if approached from the rhythmical bias, contain a precise and natural answer to some of our most perplexing problems. Furthermore, because man is subject to rhythmical procedure, calculations having to do with his activities can be projected far into the future with justification and certainty unattainable before. So basically what Elliot was saying is that if we can understand the law of nature, then we really have conquered many of our own problems. So in other words, because we are a part of nature, we fall under those same laws. So to get along, we just need to know the law. So one of the things that Elliot did, he said he paid particular attention given to the stock market for two reasons. In the first place, there was no other field in which prediction has been essayed with such great intensity and with so little result as in the equity markets or the stock market. Economists, statisticians, technicians, business leaders, bankers, all have tried at foretelling the future of prices over the New York Stock Exchange and now the global exchanges. So indeed, there has developed a definite profession with market forecasting as its objective. And now this is speaking in Elliott terms, yet 1929 came and went, and the turn from the greatest bull market on record to the greatest bear market on record caught almost every investor off guard. Leading investment institutions spending hundreds of thousands of dollars yearly on market research were caught by surprise and suffered millions of dollars in losses because of price shrinkage in stock holdings that were carried too long. His second reason for choosing the stock market is an illustration of the wave impulse common to social economic activity is the great reward attendant on successful stock market prediction. Even accidental successes in some single market forecast has yielded riches little short of the fabulous. So again, he's making reference to some of the market advances. He said in the market advance from July 1932 to March 1937, for illustration, an average of 30 leading and representative stocks advanced by 373%. During the course of this 5-year movement, however, there were individual stocks whose percent advance were much larger. Lastly, the broad advance cited above was not a straight upward line, but rather a series of upward and downward steps or zigzag movements of a number of months' duration. These lesser swings afforded even greater opportunity for profit. So what he is basically telling us here is that things operate in recognizable patterns. And these patterns have a tendency to repeat themselves. Why? Because they're human. They're produced by human beings, and we are cyclical. We do fall under the law of nature. So, but the market has its law, just as is true of other things throughout the universe. Where there is no law, there can be no center about which prices could revolve, and therefore no market instead. So instead, there would be a daily series of disorganized, confused price fluctuations without reason or order anywhere apparent. Now, that could describe how many people would take a look at a chart today and say, wow, this is just a series of disorganized, confused price fluctuations without any reason or rhythm. But to the trained eye, there is rhythm. There are definite fluctuations. We do see it, and they do tend to repeat themselves. So there is some very interesting points to be made here. And that the Elliott wave principle, it's a phenomenon that has always functioned in every human activity. So waves of different degrees occur whether or not recording machinery is present, whether that is me with a pencil and a piece of graph paper, or I'm using, in this case, I have Thinkorswim up, and now they're doing all the work for me. So when that machinery described is present, the patterns of the waves are perfected and become visible to the experienced eye. So that was kind of how he was introducing us into the rhythm of nature. But then he went on and he started to describe two basic things, which is where I'm going to get started here. Now, going over to the chart, he was describing that his first major find was that the equity markets, basically it was the Dow Jones, but the S&P is a part of that. They are forming what he then termed as building blocks. So the basic premise is that he discerned an impulse wave. And the impulse wave consisted of 5 waves. The number 5 being used is logical. So it's easy to observe that the figure 5 is prominent in other basic forms and patterns of nature. For example, the human body has 5 extensions from the torso, the head, 2 arms, 2 legs. 5 extensions from the head, 2 ears, 2 eyes, and the nose. 5 extensions in the form of our fingers from each of our arms, and 5 extensions in the form of toes from each foot. And there are 5 senses: taste, smell, sight, touch, and hearing. The basic pattern of 5s can be found throughout nature. which in the end argument, Elliot stated, in any event, 5 waves are basic to a complete social movement and can be accepted without necessity of reasoning the matter out. That I think is very, very important. If we're going to see something move and we're going to see a 5-wave pattern, many people are going to figure out, well, why did that happen? Why did that happen? And we don't need to really figure that out to understand. It's like, well, that just built the first 5 waves. What can I now expect? And then that's where he went on further. And so he talked about that 3 of the 5 waves comprising a complete movement will be in the direction of the trend. 1, 3, and 5. And waves 2 and waves 4 will be counter trend. So waves 1, 3, and 5 will move in the direction of the trend, while waves 2 and 4 will be counter trend. For the sake of remembering, odd number waves are with the trend and even are counter trend. 1, 3, and 5 with the trend, even 2 and 4 against the trend. And what he went on to say is that odd number waves are, that a 5-wave movement of 1 degree becomes the first wave of the next higher degree. So this way, I'm going to show you because it's so clean, that this is a cycle degree 3rd wave. Within that cycle degree 3rd wave are 5 waves of primary degree. Now this again is a very, very large picture. I could break it all the way down to a 2-minute chart, and we're still going to find 5s and 3 and 5 and 3. So the building block theory is very important to remember, because if you're ever trying to really listen to an Elliott wave analyst or even trying to read their daily analysis, you're going to see a lot about, well, we're in wave, primary wave 3 of cycle wave 5 and et cetera, et cetera. But even breaking it down, we can go that we're in a subminute level 3rd wave, which is within the 3 of 3 of a minor degree, et cetera, et cetera. So it can get very, very confusing to follow. But once we understand that everything within it, these are building block principle. So when we finish a 5-wave sequence, and then the whole movement would be complete when we get, let's start here, we get 5 waves and we get 3 waves. That would then be a completed 1st and 2nd wave of a higher degree. And then it just builds from there. So what I want to just really state by this particular picture is to show that it over time continues to value, it continues to operate in the exact same fashion. So people and human interaction is very chartable. Human emotions, behavioral emotional reactions are chartable, and they repeat themselves over and over and over again. So what I've learned from it is that when we can say that, people learn from their mistakes, we do as a child in terms of like you put your hand on the hot stove, you get burned after you're done crying and icing your finger or whatever. The next time you go to touch that stove, your brain's going to tell you, don't do that. If you do, you're going to get hurt again. So either you're going to learn that mistake and not do it again, or you'll be doomed to repeat it. And something as not complicated, but as complicated as an equity market or a bond market or a stock market or anything can be, we tend to make the same mistakes. So if we can clarify things a little bit by determining the path and the most probable path of where a market may go based on our own human interactions, our own behavioral reactions to a market. So most people will tell you that in the stock market or in any kind of a market, that the basic reactions are going to be fear and greed. Fear that I'm going to lose it, greed that I'm not going to get enough. Those are very, very, very powerful emotions. So however you want to break it down, what's being involved is a very strong emotional response. And we could take that all the way down to a day trade level. And why do people chase a trade? Because they're afraid that they're going to miss it. So they didn't get in where they thought they should. So they're going to start chasing it. And then as everybody else is chasing it, now it's getting away from you. Next thing you know, they're finally getting in at the top because it's getting ready to turn. But if we knew what it was forming, if we could discern a wave structure, we may not chase it at all. We may realize we need to get in here. If we don't, let it go because another one will come up. So part of what I'm talking about is how do we then put a cap on those human emotions? How do we then reach that sense of calm, the center of the storm, to really be able to pull out all of the other factors that we can trade intelligently? And I will say that it can be very, very difficult to trade emotionless, because if we're trading our own money and your position's on the line, it's really tough not to get emotional about it. But you're going to have to be, because there are times that you're going to have to react, i.e. by placing a stop. Whether you think it's going to get hit or whether you don't, you better have it there. Because one of the biggest things that people will do is, oh, I have a mental stop. Well, okay. Next thing you know, the trade is now $200 against them. Then the trade's $500 against them. But I have my mental stop. Really? How many times did you just exceed your mental stop? And then finally, now it's $1,000 against them. But they still want to believe it's going to turn, it's going to turn, it's going to go my direction. Yeah, it might, but how far do you want to let it go before you realize that you probably should have traded it all the way down and then reversed and gotten both sides? So that's what I'm talking about, that's staying in that calm. When as soon as we drop into a zone where we're allowing an emotion to guide what we're going to do, it's usually going to be denial. And then we're missing all these subsequent trades because you're still focused on one that's not working. Okay, that was a little jump in front of ourselves. So going through the building blocks. So we have what we term as our impulse waves. And in this case, it's very big, but we have 1, 2, 3, 4, 5. Those will always be corrected by an A, B, C. So here we have numbers, counter trend, letters. So, and then Elliot took each step further. And within waves 1, 3, and 5, each one must consist of its own 5 waves. So again, the building blocks, right? So let me just take this down to a level where I can show this a little bit cleaner. Let's go down to this monthly, which is going to take a lot of that data away. So now we can see. So let me just pull this open just a little bit. We can see that this is a cycle 4. So we had that A, B, C, and this actually is 2009. So that was the low of the financial economic collapse here in the United States. It did end up swirling around the globe. So off of that is where we started our next larger rally up, which was a cycle 5th wave advance. Now within that cycle 5th wave advance, there are going to be 5 waves of primary degree, which are labeled in the green. 1, 2, 3, 4. Oh, we must be in the 5th. Now, within each of the 1, the 3, and the 5 are going to be 5 waves of intermediate degree, and those are labeled in the yellow. And here in this 3rd wave, we have 1, 2, 3, 4, and 5. And, oh, I did want to show you, but that's going back. Let me just go back one step, because most people will tell you about the 1987 crash. That's it right there. And how devastating it was, and how much capital was lost in one day, and what caused it, and how it's historic, et cetera, et cetera. And now based, the great October surprise is based on that. We had the major crash of 1929 in October. This was 1987, about October. So they're always looking in October for these big smash declines. But now, in the context of the larger move in progress, you don't even recognize it. That's what I'm finding to be so amazing. That's how I mean, you could go and focus on that and miss everything that happened after, which of course is 1,000 or 2,000 times the move that's happened since. So, okay, so we have our 5-wave advances to complete, and now I want to demonstrate, this is what the building block technology really is talking about, or the theory. So within this cycle wave 5, we have 5 waves of primary degree. Within wave 1, we had 5 waves of intermediate degree to complete primary wave 1. And then we have primary wave 2, which had 2 or 3 waves of intermediate degree, but labeled ABC. That was 2. Then we had, within this particular wave, we had 5 waves of minor degree. That formed the 1. Then we had 3 waves of minor degree to form wave 2. We can see that a little clearer in this intermediate third wave. Minor 1, 2, 3, 4, and 5. So this was an interesting decline. And it really, at the time, because I was trading it, you really felt, the market dropped from 21 down to 18. So it lost 300 points pretty quickly. And so there was a lot of talk about what could happen. And then what happened? If you were counting correctly, you realized that was only just a minor 4th wave correction. We still had a minor 5th and an intermediate 3rd to complete. And we rallied beautifully. Then we correct again. That was the 4th. This was in, I guess, September to December of 2018. And that was the start of the China trade wars. We go back. It was quite a drop. It was extremely profitable, but look at it in the larger scheme of things. Almost non-existent. Then we did another 5 up that completed intermediate 5, completing the primary 3rd, and then came the pandemic. Boom. And the market lost 33%, almost 38% of its value in 3 weeks. That was very quick, and it was very severe, I will say. But when you're counting, you're like, I don't think that's it. I don't think we've reached the top of the top of the top yet. But when we were dropping, I had at the time felt, well, we're probably going to go down to the 200 moving average. Well, we didn't. It stopped, and they started to rally. That was the 4th wave. Very deceiving, but still corrective. It stopped. And look what we've done since. We have doubled the price, more than doubled the price of the S&P. And what are we forming? A 5-wave advance to complete primary 5, and in turn, cycle wave 5. And I can take it 1 higher. We are also completing a super cycle wave 3. I'm going to go back out to that maximum chart. Remember, building blocks. And you could start at the top of that food chain, so to speak. What's the largest picture that I can produce for the S&P? Based on what I have, super cycle degree. So within this super cycle 3rd wave are going to be 5 waves of cycle degree. Now I can just continue to break that down and count all the way up. Now I can do that more calmly because this is the way that Elliott works. So if I follow the rules, of which there are 4 rules, and then use the guidelines, of which there are about 9, maybe 10 guidelines that help you label properly. So what I try to tell people when you're learning Elliott Wave, learn it correctly. Don't break the rules and use the guidelines wisely. Now, if you end up breaking the rules and you still want to call it Elliott wave, it's not. It's Michael's wave, or it's Joe's wave, or it's Adrian's wave, but it's not Elliott wave. So that also is something that I'm pretty strong on, because there are a lot of interpretations of the Elliott wave theory and the Elliott wave principle. But if you're going to start adjusting it, and you're going to start saying, well, this is what fits for me to make your count work, well, then I think that's when, if you break the rules, your count's going to be inaccurate. And it may cost you in the end. And you're really calling something that just isn't happening. But the fact remains that all of our markets are fluid, which means they're in movement every Monday through Friday, basically. They're in movement, and therefore we have to operate under a two-tiered system, basically. And I only use that not so much on a monthly level, not so much even on a weekly level. If I drop this down to the weekly, here we are, still with that primary wave 4. And now we can start to see the subdivisions as we work our way up to the penultimate top. Now, again, here's the other thing that I want to keep in mind. This is just a super cycle wave 3 high, a cycle wave 5. So yes, we are setting ourselves up for a longer term, much deeper correction than most people would think can happen. Because A, they may still live in a world of fear. And if they're really going to fear that there could be downside, and they're heavily invested in a one-way move, then your reaction is going to be fear. No, that can't happen. So what do? You live in denial. And how long do you want to live in denial? Until your 401k is wiped out, until you lose 50% of your 401k, then you're going to be looking to blame somebody. But if we take all of this in on ourselves, you can be your own guru. You can learn how to interpret the market. You can learn how to read the waves so that you're going to be better prepared. Because I have to tell you one other thing. We are up in making new highs. So what am I going to base this on? What's my next projection? I don't have points where I could go, well, from here we came down and then we should at least get back to that level. Really, we're up to no man's land. This is uncharted territory. And this is where Elliott wave and Fibonacci come into glory, because it's the only analysis tool that I have found where you actually can project levels below a market where possibly it's never been and above. So as we march up into these new highs, I continue to have Fibonacci extensions that cover us. And then what you also can learn when you're learning Elliott and Fibonacci is you can start to put together the relationships between the different waves, the Fibonacci relationships, and also on the Elliott-based relationships. You're also going to know the rules. You're also going to be able to understand that, well, what can I expect from this fifth wave as it relates to the third wave? So you're first going to realize what the characteristics are, each of these movements in action. And then, so it's sort of understanding the characteristics and the personalities. For example, in an impulse wave, the impulse side, so those are the odd numbered waves, the 1, the 3, and the 5. They are all going to develop into their own 5-wave structures. One of them, either 1, 3, or 5, will extend. Within it, will extend. Most often, that's going to be the third wave. So the third wave is often determined and known as being the longest and the strongest segment within a 5-wave impulse move. Now, impulse, please understand, is both up and down. Waves can definitely, markets can impulse lower. So if we shift from bear to bull, bull to bear, we're going to be, our trend So those impulse waves will be in the direction of the trend. If it's bear, it's going to be down. But right now, we're still counting in a bull market. So the impulse waves are up. So then the next thing that we can add to this is that on a Fibonacci basis, there are relationships between the third wave and the first wave, wave 2 and wave 4 as corrective waves, and then wave 5 and wave 3. And over the years, what Elliot did realize is that the patterns are consistent, and now we can start to draw out of that, what are the characteristics of these waves? So what can I expect? And consequently, what has happened through that is that fifth waves within a stock or an equity market are different than a fifth wave in a commodity or precious metals market. So in other words, within an equity market, and also bonds, but mostly within an equity market, the third wave is the one that's going to be the longest and the strongest. Whereas in a commodity market, including precious metals, it'll be the fifth wave. The fifth wave is most often the longest and the strongest wave. It's where they'll just sail to a high or sail and crash to a low in a fifth wave. So, but back to the equity. So as I continue to count, I'm going to go over to my other chart actually, because now you're going to be able to see how no, that didn't work. Yeah, that'll work. Let's go over to the ES, which of course is the S&P future. Now you're going to continue to see how I'm labeling it. So there again, we have the primary four. We're looking at a primary fifth wave to complete a primary five, an intermediate five, first of all. Intermediate five, primary five, cycle five, and super cycle third wave. So what am I looking at from all of this when this comes through? I am looking for a super cycle fourth wave. And that's going to be followed by a super cycle fifth wave advance. So this isn't anything that is out of the ordinary. Now, people are going to say, oh, the market's going to crash. It's like, depends on what your idea of a crash is. Will they do that? Yeah, more than likely. And I'll tell you, when this was happening, it felt like a crash. I've never traded a day where the Dow Jones was down, $3,000, $4,000. But it happened during that just post-pandemic decline. Absolutely fabulous trading days, because those are the days you got to stand in that panic and you have to be able to trade. And things are moving at the speed of light. And they truly were. And they were just being swamped with a huge seller after another huge seller after everybody was bailing and getting out. So if you don't want to miss those opportunities, you have to be able to clear-headed go walking into a market like that and make a decision real quick on how you want to trade it and what you want to do, because it will move very fast. Do I expect when this reaches its top that it's going to move quickly? Yeah, I do. But not outside of the relationships or the characteristics of the particular wave that it's forming. So that's another part where within You Are Your Own Guru, which by the way is an ebook that I continue to write and add to, but I have 2 parts are available now. But in any case, what I describe in them are the characteristics of each individual wave. What are the personalities of these waves? How do I determine where we are? By understanding what the personalities of the waves are, and understand that those personalities of those waves are really driven by us, human beings. It's our human reactions. Got to get in, got to get out. Oh my God, I'm missing this trade. Oh my God, look at this rally. I want to be a part of it. Oh my God, this is declining. I need to get my profits. All human emotions, and they really do come into fruition. And once you really can wrap yourself around Elliott, you will understand it very cleanly. And let me just go. Yes, Danny, I will actually show you that. And the wave fours are kind of short in time compared to the preceding wave threes. Yeah, they are. And there are time factors that people do add to these. But when we look at it as a whole, this one, yes, it was 3 weeks and on primary degree, but it was because of the depth and the size of it. But you're right, it was a very short third wave. But what else are you going to call it? You know, basically, when you're following your count and you've worked it out and you see it, then you understand that that's what it is. Corrections, let me put it this way. The market corrects much faster than the other direction, than it will in the direction of the trend. The trend may seem like it's moving, but it takes a lot more time to get up here than it did to get down there. It took a lot more time to get up here than it did to get down there. So there was panic. And that's what will happen when you get into big enough correction. Now, what I want to talk about is when we combine. So first of all, we understand how we're going to label the waves. We understand the characteristics of the waves. We understand the building block theory. Then we can start to label. Now, when you're approaching a market that you've never labeled before, you always start with the largest picture you can find. So that would be the most data that you can find. And as I showed you with the S&P, I got back to 1928. In the Dow Jones, I can go back to 1903, I believe my chart goes to. And that's just public data that's available through Thinkorswim. I can go to other sources. And I have in the past pulled handwritten data, but data that goes back into the 1800s. And so that would be in the 19th century. And you can go back and you can find written documents about the start of the New York Stock Exchange. And that would be back in the 18th century. So there's still much available data. And now a lot of it, of course, has been electronic and translated. But with the advent of this beautiful chart, I no longer have to do it by hand. So when I first started doing Elliott Wave, I was on a trading floor, I was trading, but I would take my trading card out, and once an hour, I would copy down where that market closed, where the index closed. And at the end of that day, I would put them on my chart paper and I connect them with a pencil. And that's how I formed my chart. And that's how I formed my count. Now it's all being done for me on a 30-second basis if I want. It's fantastic how quickly now you can get your Elliott Wave count put together. But this is a weekly. So once we start to learn the relationships, now we can add the other tool that actually R.N. Elliott found and started to apply it. And this truly is the law of nature. And Leonardo, and actually his if I have to say, his was known as Fibonacci, but that wasn't his number, his name. He in Italian means sun. So it was, his name was, hold on, I'll get it right down to there. Nope, that's not the one, this one. Excuse me while I just find this. It's his true name was Leonardo Bonacci. But because there was an Italian historian in the 19th century who shortened it by saying Bonacci or son of Bonacci, so it's Fibonacci. Fibonacci. That's how that came up, but his name was actually Bonacci. And he came up with a number sequence. And this number sequence is just the guide to the law of nature and how it really functions and how we are constructed in a Fibonacci number sequence and how our face is constructed and our brains are tuned to find and to accept Fibonacci relationships between when our eyes are a Fibonacci number apart from the center of our face, from our nose, from that line. If one of our eyes happens to be crossed, as it'll be noticed because, and it's not that we're noticing somebody's defect. It's just that our brains are set up in Fibonacci number sequence. That's what we accept. When we look at a piece of cauliflower, or we look at a piece of broccoli, we just accept all of the Fibonacci relationships that are in that, the 5 to 3, the 5 to 3 that repeats and repeats and repeats and repeats and forms a head of cauliflower, a head of broccoli. So you'll find these in nature. This is an important thing to kind of grab hold of and accept. But now, Elliot started to use Fibonacci number sequences in how and far particular waves can go and what we can expect in corrections. So now we have the ability to combine, oops, I'm going to take this all the way down to the hourly chart. We can combine Fibonacci relationships to help us determine depth and where the market can go next. So that's what I do. I apply Fibonacci extensions and Fibonacci retracements to the markets that I trade. I apply Elliott wave to the markets that I trade. And it has guided me for all these years. Now, Elliott wave is not wrong. It's how it's applied. It's how it's interpreted that may be wrong. Now, again, in my own work, when I'm realizing that this whole process is this market is fluid, it's ongoing, it changes every day. So when I'm labeling on a small level, I have to learn and also accept that initially I may have thought, okay, there you go, there's the third, 1, 2, 3, 4, 5. Okay, I'm putting the third there. But that wasn't the case, because then I have to understand that under Elliott, waves extend. So maybe this was just part of the extension. And that's in case that's exactly what happened. And you can base that on, if indeed this was the third, then what I'm looking for is a 4. And this then should have shown that the market's going to come down and break that level. Excuse me. If it was a true fourth wave. It wasn't. It ended there. And we started to rally again. Well, then that's what I mean by fluid. As the market is fluid, you must remain fluid in your count. So it never becomes a matter of you're right or you're wrong. It becomes a matter of following what the market is telling you. So you'll see that one of the things that I always talk about is that let the market tell you what it wants to do. There's a few things that I've always told. It's like, you know, if you're an old options trader, you have to understand that options are always perfectly priced. The market is always perfectly priced. At that moment, buyers and sellers can meet. That's the price. It's perfect. We may not agree with it, but it is perfectly priced. Then what is your choice you get to do? You're either going to take advantage of the overvaluation, or you're going to take advantage of the undervaluation, but you're going to try to find the inaccuracies and make money on it. Okay, so we need to move past you're right, you're wrong, you're never right, you do this, you're that, because you're just surrounding yourself with negatives, and that's never going to work. But if you stay open to the possibilities and you play against doing a count where you're doing I call them preferred and alternate views. Your preferred view is this is what I think the market is going to do. But the alternate view is telling you what the opposite could happen. And I'm also going to show you where those breakpoints could be. So when you're learning Elliott, make sure that you're learning from somebody that's going to be able to tell you, if that gets here, if you let this rule break, then it's not going to be a fourth wave. It's going to be something else. So in other words, if I'm counting this as 1, 2, and I put the 3 there, and this starts to come down, I said very cleanly, the break level is 46.61.25. So if it broke below 46.61, boom, it's not a fourth wave. Because a fourth wave cannot overlap the price territory of wave 1. That's one of the rules. Another rule, out of 1, 3, and 5, wave 3 is most often the longest and the strongest wave. But what it cannot be is the shortest way. So if I'm counting 1, 2, and I put a 3 here and a 4 and I put a 5, and then this labeling just gets all disjointed, what did I do? I broke a rule. Wave 3 can never be the shortest wave out of 1, 3, and 5. Right? Wave 4 cannot overlap the price territory of wave 1. Boom. It's a rule. Don't break it. If you do, change your count. Don't force it. Change your count. The only time that Elliot really talked about a rule violation was in the case most often in a corrective wave. And he talked about that if every other available tool, every other available count just does not work, then allowing for a slight discretion would have to be acceptable, but nothing on a major level. So I'm talking about small levels. This is a minute level degree, so minor. So above all of this, what am I completing up here? When this gets up here, I'm completing a minor 5, an intermediate wave 5, a primary wave 5, and a cycle degree wave 5. Those are the 3 that I'll be completing. This has been one hell of a wonderful rally. This rally that we're completing, this is the one that started off of the March 2020 lows. So when I'm looking at a correction from here, I'm looking for it to come as a minimum down into the price territory of that 4th wave, the primary 4th wave. Why? Because I'm going all the way up to a cycle degree wave 5. So the first move out of the box is going to be a primary wave A down, because I'm looking for a much larger correction. And eventually that larger correction is going to be on a cycle level. So I got to move this chart out even further to find out where that price territory is. So, because one of the guidelines that Elliot gave to us is that a 4th wave, or the corrective process after 5 waves, the corrective process will be that quite often that correction will come down to the terminus or within the price territory of the 4th wave of one lesser degree. So when I get up here to this 5, the first support level that I'm looking at is the minor degree. But these are building blocks. So as this gets bigger, when the market goes down and moves beyond that level, then I'm moving this whole chart out, and I'll move it up to a 4-hour chart. Now I'm looking at this 4th, and then when it passes that, what am I looking for next? Well, now I'm going out to the daily chart. I can't find that 4th. So now I'm going to go back out to that weekly chart, and guess where I'm going to be? I'm down to this 4th. Intermediate degree, primary degree. And if I really want to look to see what potential does this have to get to? That one. That's the 4th wave of cycle degree. And I just said what we're going to be completing is, or I don't have it on here because I don't have enough data, but it is that super cycle degree 3rd wave. So where would a super cycle degree 4th wave come into? The price territory of the 4th wave of one lesser degree. That's this one. Now, how long should this take? This gets back to your question that was asked before. This particular 4th wave on a cycle degree took 9 years. That's what I'm looking for. Again, I'm expecting this to take between 3 and 9 years. So, but each individual component of it, maybe it takes a year to get down to here. Maybe faster. It only took us 3 weeks before. So, but we can wrap certain things around it that help us to form an opinion on what the potential is. And then we can then follow the market and put a probability weighting on that as well. So this is what I'm talking about of being your own guru. So I'm going to wrap it up here because obviously it's a lot to try to cram into one presentation. But what I want to say is that it has stood the test of time. Obviously, since I've now got charts that I've charted on and counted for, and I wasn't alive in 1932. I am older, but not that old. But again, the data I could follow, and how I started that count was going back and reading R.N. Elliott's original works. And I did all that on the Dow, which is the market he wrote about. And I want to pull this open so you can see the Dow on a maximum. And that chart goes back to 1902. You can read it right up there. 1902. Oops. 1902. February of 1902. So Elliot himself talked about how this was grand supercycle. That's the absolute top. Personally, I don't go that far out because I doubt that I'll be around for grand supercycle wave 5, right? If grand supercycle wave 1 started in 1858 and ended in 1929, these are very, very long-term moves. Why do I need to talk about that now? So this, I think going to a supercycle level is kind of getting out of bounds, but we're up so high and what we're completing dictates that I do that. And so then you can bring that all the way back down again into your, I use a 1 minute, a 2 minute, and a 5 minute chart to day trade on. So let me just quickly just talk about what I have for today. I do offer the first 4 lectures in my ebook, which You Are Your Own Guru. David, I think, is going to put on my website, which is at Teachable. So it's www.logical-signals.teachable.com. When you get in there, you will see that there's You Are Your Own Guru Part 1. That one I allow free. That one's up for grabs for free. And that's the first 4 lectures. So you can start to get an idea of what I'm talking about. You may need to use the coupon code GURU4. So bear that in mind. Go ahead and write that down. The next thing I'm actually on offer is that I've decided that I'm going to do a Black Friday type deal for my trade room. And so I run a trade room, and the basis of my trade room is basically education. I do like to teach people how to become self-trained, so, how they can do this on their own. They can understand how these work. And you see all these other lines on there. That's the other major factor that I use for day trading. Moving averages. Moving averages tell the story. Charts tell the story, but moving averages help to tell you about price action and what's up and where it's going to go. And so I teach Elliott, Fibonacci, and moving averages for day trading. And then being able to read the price action and being able to either determine, is this a swing trade? Is this a trade that I need to just scalp, et cetera, et cetera. So in that trade room, again, I'm offering Black Friday deals, and you can find them on the same website, teachable.com. Sorry, I'm sure David's going to put that in the chat box, and that would be great, David. Thank you very much. I'm going to turn it over to you. Thank you very much for your attention. I know this goes by so quickly, but thank you very much for your attention. I hope it was worthwhile.